Over the last few days, Chinese stocks, Chinese equities have seen a massive and explosive rally as the Chinese central bank and government pulled out the fiscal and monetary bazooka, a stimulus package aimed to revitalize the Chinese economy. And as a result, the KraneShares CSI China Index ETF is up nearly 40% over just 2 weeks. The stock of JD.com has skyrocketed by an astounding 60% over the same time period, and the MSCI China Index surged almost 25% in September alone. And even the formerly hated Chinese tech giants Alibaba and Tencent, they have managed to outperform US benchmarks by quite a wide margin in 2024. So the question I want to pose in this video is whether this rally is the beginning of something bigger, or whether we are looking at an overreaction by market participants to the stimulus package. We're going to look at a couple of different data points. We'll look at the numbers of Chinese companies, Chinese stocks, the narrative surrounding Chinese stocks, and we are going to try to answer the key question: has China just become investable again? So without further ado, let's get started. All right, hi there. I think we need to start this video with an interview that was published by CNBC last week, an interview with fund manager David Tepper. And I think this video marks a remarkable moment when it comes to the Chinese stock market. Let me just play it to you here, or sequences of it to you.
What are you doing now? Did the China moves over the last few days, but just because you were saying in the past you wouldn't go more than 10 or 12%, or the most recent things we've seen are that you have about 12% of Alibaba. Does that mean you put those aside and you would own even more than that?
As I said, the value at risk model is what I sleep at night. I went over that limit on the Fed announcement, in the last week. I went more when they said a day or two ago on their Fed, and last night I did more.
Just Alibaba?
So if we just stop here for a second, we can tell just by looking at David Tepper's body language that he apparently feels extremely comfortable having allocated a significant part of his portfolio, more than 12%, to Chinese equities. Let's see what else he had to say.
Just Alibaba? Or are you talking JD, Baidu, PDB, the two Chinese ETFs? Everything China.
ETF, I would do futures, right? Mm-hmm. Everything. Listen, a long time ago, in 2010, I think I said everything.
And you I remember when you said everything.
And you know what's good?
You were right.
Everything. Okay. So if they, this is incredible stuff for that place. Okay. So it's everything. Now I would love to see a pullback. Okay, because I will then. My newfound limit, which might have been twice my old found limit.
25%?
You said 10 to 12 is double.
20 to 24%. So
I'm not going to say what it is.
Is the limit 25?
I will have another newfound limit, okay, in a pullback, okay, if I see these absolutely be implemented. Because, again, you can look at these names, and you're talking about single-digit PE multiples with double-digit growth.
But you think there's
wait a second. Yeah. This is the other thing. You have some of these stocks with 50% cash. Some of these things you just put up on the board, 50% cash, 20% cash, 30% cash. And that cash, depending how the Chinese currency goes, maybe if the Chinese currency is really strong, they'll want them to buy back.
Okay,
Okay, if I stop here again for just a second as he's talking about possible benefits from how the currency exchange rates change. That is not a game I try to play. Obviously, this may have a positive impact, but on the flip side, it might just as well be a headwind to your investment. So I don't really count on this as a pillar in my investment framework. However, what I can relate to, and we'll discuss this in depth in this video, is that Chinese stocks are simply cheap. He was talking about stocks trading at single-digit PE multiples. So if you sort of turn this around and look at the earnings yield, you look at say a 10% earnings yield combined with, as he said, a double-digit growth rate. So let's just say your earnings yield is 10% and you expect the company to grow earnings at a rate of 10%. Assuming there's no change in the valuation multiple, you already see a 20% return. It's as simple as that. And that's why I think David Tepper is so excited in this clip right here. Let's finish that clip here.
David, let me ask you.
They're asking you, did you see this thing? Buying back stock, when companies buy back their stock.
Right, but you're a hedge fund. How do you hedge your risk? What's the counter bet that you put on that, just in case?
You know what? I'm sitting here in a suit, My counter bet is that I don't care.
And I have to say that this last punchline really got me laughing out loud. It has me laughing out loud again because like clearly he is incredibly confident in his bet in China, and he really doesn't care about any limitations, formal aspects that he has to stick to as a hedge fund manager, because he has such a high conviction apparently in his Chinese bet. So his hedge, to quote him again, is I don't care. So in this video, we're going to discuss a lot of what David Tepper was saying in this video. We'll take a look at the valuation of individual companies. We will take a look at the valuation of the Chinese equities market as a whole. We will take a look at some of the the tailwinds that the Chinese economy is likely going to enjoy. I would say we are going to jump right into this question now. And the question I want to ask you is, well, can this rally be the beginning of a longer, extended, long-term bull market in Chinese equities? Obviously, I don't know what will happen in the short term, but I think in the long term, there's a good chance that this is what we can sort of expect here. And I think there are a couple of reasons for this. So I think I've identified 3 reasons. The first one is that I would argue that most of the more recent rally of Chinese equities was driven by an expansion of the valuation multiples Chinese equities were trading at. And clearly, as David Tepper just highlighted, Chinese stocks were and still are arguably trading at extremely cheap valuation multiples. So if you go from very cheap to cheap, obviously there is still room to grow for the valuation multiple itself without the actual businesses growing their earnings power. So if we just take a look at this chart here, for example, it shows the valuation multiple, the PE valuation multiple of the Hang Seng Index and the CSI 300 Index. And as you can see, obviously the valuation multiple has increased more recently, but we're still only looking at a multiple as of September 24th, so we might be a little higher today in early October, but we're still only looking at a PE multiple of these indices of 9.5 and 13 times, which, as you can see, is still below the 5-year historical average for both of these indices. And I can show you actually another chart here that compares the PE ratio of the CSI 300 index to the valuation multiple of the S&P 500. And we can see that it is trading at a steep discount to the US index, almost at half the multiple, basically. However, I'm sure that you could argue that there is a reason why Chinese equities are trading at a cheaper multiple than US stocks. The angle that I presented here is certainly only one way to look at this situation. On the other hand, you could argue that the Chinese economy is centrally driven, not necessarily rationally run all the time, opposed to the US economy, which is clearly performance driven and has a 50-year track record of delivering insane value to shareholders. Then you might also factor in things like population growth, how much households are actually spending in China and the US, and many different factors, and you will clearly arrive at a conclusion that will show you that, well, maybe there's a reason why US stocks deserve to trade at a premium, and maybe even a significant premium over Chinese equities. And then just to wrap up this first part, focus on the current valuation of Chinese equities. You could, of course, also take a look at the valuation of individual stocks, such as Alibaba. And again, just to show you that many of the Chinese stocks are still trading at relatively cheap multiples, and that there may still be a lot of runway for future share price growth ahead of these businesses. Let me show you this chart here that shows the development of Alibaba's free cash flow on a per share basis and Alibaba's share price. And you can see that there's a significant gap between the two, which again doesn't necessarily mean that the share price will continue to go up, but it's sort of an indication that there is certainly still room for a future expansion of the valuation multiple for Alibaba stock specifically. That there is room for the two metrics here to converge over time, because usually, just to be clear, over time, these two metrics, they converge. All right, this brings me to the second factor that I wanted to discuss here. If we think about the returns generated by stocks, obviously the change in the valuation multiple is only one source of investors' return. The other one would be earnings growth. And the Chinese economy has been struggling more recently, which partly justified the poor stock performance of Chinese stocks. Now, with the new fiscal and monetary measures installed by the government and the Chinese central bank, there is maybe a reason to be more optimistic about the Chinese economy over the near and the midterm, I would say. As I said, the package that the government and the central bank brought on the way, Chinese consumers are more likely to start spending the massive savings that they have already piled up. We need to see a change in the consumer sentiment, because oh boy, if you look at the data, Chinese consumers, they have a lot of cash that they are sitting on right now, especially compared to the US. Again, I want to show you a chart here real quick. So Chinese households actually have close to 21 trillion US dollars sitting in their bank accounts compared to US households, which are just sitting on around 900 billion. And generally speaking, the consumer spending in China has been relatively low, and it has historically always been low. But I think there's reason for hope that Chinese consumers will start spending more money in the future, considering the stimulus package, which again would then fuel earnings growth of many Chinese businesses, which again would then translate, hopefully, into favorable stock returns. Okay, and then the last factor that I think is important to mention in this video, again, the question is, can this rally continue? Is the exposure that US fund managers have to the Chinese stock market. And this exposure is still sitting at an all-time record low. Again, I've brought a chart that I want to show you here, which shows the China allocation in active funds globally, actually. And as you can see, it's sitting at around 5%, which historically is, well, very, very low. And I also want to quote the investor Tiho Birkan here, who wrote, "Fund managers are extremely underweight and underexposed to Chinese stocks. They are all currently playing the catch-up game. In recent quarters, the trendy thing to do was ABC, anything but China. But with Tepper's CNBC appearance, it might be AIC, all in China." And before we move on, I would like to know what you think. Is it now time to go all in China? Just to tell you how I am positioned right now, just to be fully transparent here, I actually owned Alibaba for multiple years now. Alibaba has been a terrible investment. I lost money on it and quite recently actually sold my position. And that's not because I believe Alibaba will not continue to do well from here. I think there is a good reason to believe that the business will continue to do well and that the stock will do well as well. However, as an investor, you always have to be aware of opportunity cost. And I just found an opportunity in a Western market where the rule of law is fully respected that I find at least equally attractive, maybe even more attractive. And that's why I used the recent stock surge in Chinese equities to actually fully exit my Alibaba position. But again, that's not a call that my Alibaba will not do well going forward. In fact, I believe that Alibaba will likely continue to do well from here. All right, and this brings me to the last part of this video. I think what some people will point out in the comments down below is again that, well, if you invest in Chinese stocks as someone living in the US, for example, you're not really owning these stocks due to the VIE structure of Chinese equities. They would argue that, well, all of these Chinese stocks, they are just faking their numbers and chances are you will get burned. And quite frankly, as I did own Alibaba, I never believed in this narrative. I believe the US and China are just too interconnected in a globalized world that one can actually operate economically without the other, which I believe that you will not all of a sudden lose your ownership stake in a Chinese equity. That is a narrative I never believed in. And I think the fact that we have seen a major change in capital allocation at many Chinese companies, with many Chinese companies aggressively buying back their stock or even paying a dividend, it showed that you actually do own a piece of ownership in these businesses, because these dividend payments, for example, they were hitting your brokerage account. And that is something that Robert Vinal actually also addressed in one of his most recent letters. Let me just read a part, or the part that was focused on Chinese equities to you here. So Robert Vinal, he wrote, "A China basket. In the first half of the year, I added one additional Chinese company to the portfolio, NetEase, a video gaming company. Since the end of the period, I added 3 more. Yum China, the operator of KFC and Pizza Hut in China, H World, the second largest hotel company in China, and Didi, the dominant rideshare platform in China. This takes the total number of investments in China to 6. I do not rule out buying further investments, but I will keep the overall China exposure. The valuations in China are the most astonishing I have seen in my investment career, including during the great financial crisis of 2008 and 2009. Take the companies we own. They are blue chip, with dominant competitive positions in their respective industries. They are highly profitable, they have oodles of net cash, they are growing at the top and bottom line, despite the struggling Chinese economy. Despite these favorable characteristics, they trade at PEs ranging from mid-single digits to low double digits, and 5 of the 6 are aggressively returning cash to shareholders. As an aside, Chinese companies have undergone a sea change in recent years in terms of returning capital to shareholders and their overall competitiveness. I remember remember when the consensus was that Chinese companies would never return capital and would never amount to more than low-cost manufacturers. When it comes to reporting on China in the West, it seems that the good news travels slowly. Many Chinese companies have started aggressive capital return programs. Lufax, a financial services company, even paid a dividend earlier this year that was greater than its market capitalization. The continuous discussions about trade and tariffs and import bans is, in essence, an acknowledgement in the West that Chinese companies are increasingly hard to compete with across all sectors. And then he wraps it up by saying, I'm conscious that investing in China is far from risk-free. As Spider-Man Uncle Ben might have said, on the topic of investing, with great opportunity comes great risk. However, I believe we are getting paid to take the risk without wishing to step on Uncle Ben's toes. The bigger the opportunity, the lower the risk. Risk can, by definition, never be greater than 100% in an unleveraged portfolio such as ours. So the greater the upside, the more favorable the overall risk-return calculation. Yes, and I will wrap it up here. Let me know what you think of Chinese equities. Would you ever touch them? Why or why not? Do you think the recent bull market can continue to go up? Does the bull market have legs? Does the bull market have legs to it? And with that, I'll wrap it up. I'll see you in one of my next videos. Take care.